All right, now we're going to look at the three financial statements: income statement, balance sheet, and cash flow. And what I want for you as we look at these three financial statements is one, to understand what each statement is telling you. What story is each statement telling to you? And I also want you to understand the different parts of each statement and what those different pieces, different sections of the statements are telling us. So the first financial statement that we'll look at, and the most popular financial statement for small business owners, is the income statement. I'm going to guess that about 75% of small businesses look at an income statement. It's the most popular financial statement. And by definition, the income statement is a statement of income and expenses over a given period of time. And that period of time could be a day, it could be a week. Oftentimes it's a month or even 12 months, a 1 year time period. So, and one way to look at an income statement is it's like a video of your company's financial performance over a period of time in terms of revenue and expenses. Revenue, expenses over a period of time. So if you look in your book, you'll see a sample income statement. Very simple example of an income statement. Notice on the top of the statement, it tells us this is an income statement for 1 month ending January 31st, 2000 XX. So this is a 1 month income statement. The top item almost on every income statement is revenue. Some people call this sales, same thing, sales, revenue, same thing. We then subtract from revenue our cost of sales. Some people also call this direct expenses, variable expenses, costs of goods sold. They all mean the same thing, cost of sales. So we subtract cost of sales and we arrive at our gross profit. Now, every business has a cost of sales. I've yet to find a business that didn't have a cost of sales, because essentially cost of sales measures what does it cost me to make a sale. So if I'm selling my favorite pen here, if I'm a retailer, my cost of sale would be whatever I paid for this pen from the wholesaler. So if I paid $2 and I'm selling it for $4, my revenue would be $4 when I sell it. My cost of sales would be $2. If I make these pens, if I manufacture these pens, my cost of sales would be the materials that go into making this pen, the labor that goes into this pen, the packaging of the pen. Those would all be cost of sales. Every company, I've yet to find a company that didn't have cost of sales. It's impossible to have revenue and not have some expense related to that revenue. All right, so we get gross profit, and then after gross profit, we have all of our operating expenses. Sometimes we call this overhead or fixed expenses, salaries, insurance, marketing expenses. Again, you'll see not a lot of detail in this example of an income statement. Your income statement may have more detail. One expense I want to draw your attention to towards the bottom of the expenses, put your finger where it says depreciation. Depreciation. This is one that sometimes gets confused. Depreciation is what is considered a non-cash expense. Non-cash meaning we don't write a check for depreciation. Depreciation is the way that we expense our fixed assets. So if I go out and buy a $1 million piece of equipment for my business, the IRS, under normal circumstances, doesn't allow me to expense that entire $1 million in one time period. What they say instead is that I have to expense that piece of equipment over the lifetime of that piece of equipment. And so I'll ask my accountant, I'll say, Mr. Accountant, what's the lifetime of this piece of equipment? And he or she may say 5 years. That piece of equipment's going to last you 5 years. So I'll take the $1 million that I invested in the piece of equipment, divide it by 5 years, and I'll depreciate that piece of equipment. I will expense that piece of equipment. $1 million divided by 5 is $200,000. So on my income statement, it's going to show as a depreciation expense of $200,000. Depreciation, a non-cash expense. Similar to depreciation is what's called amortization. Amortization is how we expense intangible assets. Intangible meaning not is something I can't touch, something I can't feel or see, but it's an asset. It's something of value on my balance sheet. So maybe the best, let's see, what would be a good example of an intangible asset? Intangible asset would be if I purchase another company, if I purchase Helen's company, and on paper, her company is worth $500,000, but I think it's such a good company that I pay her $1 million, great company. So on paper, it's worth $500,000. I pay her $1 million for the company. The difference between the book value and what I pay her for her company is considered an intangible asset. So it shows up on her balance sheet as $500,000, and then she's able to expense that intangible asset on her income statement, again, over a period of time. Okay, that's a little deeper into accounting than we need to go, but I just want to give you some sense of what those expenses are, depreciation and amortization. If you have any question about your depreciation expense or amortization, again, good thing to talk to your accountant about in doing your taxes.